Good morning, good afternoon, and good evening. Today we will talk about Chapter 15, Part 2. Keep going. A specific index fund portfolio. The table on page 389 presents specific index fund selections that investors can use to build their portfolios. The table shows the recommended percentages for those in their mid-50s, the group I call the aging boomers. Those who are not in their mid-50s can use exactly the same selections and simply change the weights to those appropriate for their specific age group. Remember also that you may want to alter the percentages somewhat depending on your personal capacity for and attitude toward risk. Those willing to accept somewhat more risk in the hope of greater reward could increase the proportion of equities. Those who need a steady income for living expenses could increase their holdings of real estate equities and dividend growth stocks, because they provide somewhat larger current income. A specific index fund portfolio for aging baby boomers. Cash 5%, asterisk. Fidelity Money Market Fund, FXLXX, or Vanguard Prime Money Market Fund, VMXX. Bonds and bond substitutes, 27.5%. 7.5% U.S. Vanguard Intermediate Term Bond, VACSX, or iShares Corporate Bond ETF, LQD. 7.5% Vanguard Emerging Market Government Bond Fund, GAVX. 12.5% Wisdom Tree Dividend Growth Fund, DGRW, or Vanguard Dividend Growth Fund, VDIGS. Real Estate Equities, 12.5%. Vanguard REIT Index Fund, VGSIX, or Fidelity Spartan REIT Index Fund, FRXIX. Stocks, 55%. 27% U.S. stocks, Schwab Total Stock Market Index Fund, SWTSX, or Vanguard Total Stock Market Index Fund, VTSMX. 14% developed international markets, Schwab International Index Fund, SWISX, or Vanguard International Index Fund, VTMGX. 14% emerging international markets, Vanguard Emerging Markets Index Fund, VIEX, or Fidelity Spartan Emerging Markets Index Fund, FFMAX. Asterisk a short-term bond fund may be substituted for one of the money market funds listed. Although it doesn't fit under the rubric of an index fund portfolio, investors might consider putting part of the U.S. bond portfolio in Treasury inflation protection securities. The dividend growth and corporate bond funds are also an exception since they are not standard index funds. Remember also that I am assuming here that you hold most, if not all, of your securities in tax-advantaged retirement plans. Certainly all bonds should be held in such accounts. If bonds are held outside of retirement accounts, you may well prefer tax-exempt bonds rather than the taxable securities. Moreover, if your common stocks will be held in taxable accounts, you might consider tax-managed index funds. Finally, note that I have given you a choice of index funds from different mutual fund complexes. Because of my long association with the Vanguard Group, I wanted also to suggest a number of non-Vanguard funds. All the funds listed have moderate expense ratios and are no load. More information on these funds, including telephone numbers and websites, can be found in the Random Walker's Address book, which follows this chapter. ETFs may be used in lieu of mutual funds. ETFs and taxes. One of the advantages, noted above, of passive portfolio management, that is, simply buying and holding an index fund, is that such a strategy minimizes transactions costs as well as taxes. Taxes are a crucially important financial consideration, as two Stanford University economists, Joel Dickson and John Chauvin, have shown. Utilizing a sample of 62 mutual funds with long-term records, they found that, pre-tax, $1 invested in 1962 would have grown to $21.89 in 1992. After paying taxes on income dividends and capital gains distributions, however, that same $1 invested in mutual funds by a high-income investor would have grown to only $9.87. To a considerable extent, index mutual funds help solve the tax problem. Because they do not trade from security to security, they tend to avoid capital gains taxes. Nevertheless, even index funds do realize some capital gains that are taxable to the holders. These gains generally arise involuntarily, either because of a buyout of one of the companies in the index, or because sales are forced on the mutual fund. The latter occurs when mutual fund shareholders decide on balance to redeem their shares and the fund must sell securities to raise cash. Thus, even regular index funds are not a perfect solution for the problem of minimizing tax liabilities. Exchange-traded index funds, ETFs, such as SPDRs, an S&P 500 fund, and VIPERs, a total stock market fund, can be more tax-efficient than regular index funds because they are able to make in-kind redemptions. In-kind redemptions proceed by delivering low-cost shares against redemption requests. This is not a taxable transaction for the fund, so there is no realization of gain that must be distributed to the fund's other shareholders. Moreover, the redeeming ETF shareholder pays taxes based on his or her original cost of the shares, not the fund's basis in the basket of stocks that is delivered. ETFs also happen to have rock-bottom expenses, sometimes even lower than those of equivalent mutual funds. A wide variety of ETFs are available not only for U.S. stocks but for international ones as well. ETFs are an excellent vehicle for the investment of lump sums that are to be allocated to index funds. ETFs require the payment of transactions costs, however, including brokerage fees and bid-ask spreads. No-load index mutual funds will better serve investors who will be accumulating index shares over time in small amounts. I suggest that you avoid the temptation to buy or sell ETFs at any hour of the day and to buy such funds on margin. I agree with John Bogle, founder of the Vanguard Group, who says, "Investors cut their own throats when they trade ETFs. If you are so tempted, follow the practice of Little Miss Muffet and run far away from the SPDRs and their siblings." In the table on page 392, I list the ETFs that can be used to build your portfolio. Note that for investors who want to make their stock buying as easy as possible, there are total world index funds and ETFs that provide total international diversification with one-stop shopping. Exchange-traded funds ETFs, ticker expense ratio total U.S. stock market Vanguard total stock market VTI 0.05% iShares Russell 3000 IWV 0.2% developed markets, EAFE. Vanguard Europe Pacific VA 0.09% iShares MSCI EFA 0.35% Emerging Markets Vanguard Emerging Markets VWO 0.15% iShares MSCI Emerging Markets EM 0.67% Total World ex-US Vanguard FTSE All World EX-US View 0.15% SPDR MSCI ACWI ex-US CWI 0.34% Total World including US Vanguard Total World VT 0.18% iShares MSCI ACWI ACWI 0.34% Bond Market U.S. Asterisk Vanguard Intermediate Term Corporate Bond VCIT 0.12% iShares Investment Grade Corporate Bond LQD 0.15% asterisk Taxable investors should consider the closed-end municipal bond funds listed on page 405. If you want an easy, time-tested method to achieve superior investment results, you can stop reading here. The index mutual funds or ETFs that I have listed will provide broad diversification, tax efficiency, and low expenses. Even if you want to buy individual stocks, do what institutional investors are increasingly doing: index the core of your portfolio along the lines suggested, and then take active bets with extra funds. With a strong core of index funds, you can take these bets with much less risk than if the whole portfolio were actively managed. And even if you make some errors, they won't prove fatal. The do-it-yourself step, potentially useful stock-picking rules. Indexing is the strategy one recommend most highly for individuals and institutions. I do recognize, however, that indexing the entire portfolio may be considered by many to be a very dull strategy. Those with speculative temperaments will undoubtedly prefer using their own steps and wits to pick winners, at least for some portion of their investment funds. For those who insist on playing the game themselves, the do-it-yourself step may be appealing. Having been smitten with the gambling urge since childhood, I can well understand why many investors have a compulsion to try to pick the big winners on their own and a total lack of interest in a system that promises results merely equivalent to those in the market as a whole. The problem is that it takes a lot of work to do it yourself, and consistent winners are very rare. For those who regard investing as play, however, this section demonstrates how a sensible strategy might produce substantial rewards and, at the very least, minimize the risks in playing the stock-picking game. Before putting my strategy to work, however, you need to know the sources of investment information. Most information sources can be obtained at public libraries. You should be an avid reader of the financial pages of daily newspapers, particularly the New York Times and the Wall Street Journal. Weeklies such as Barron's should be on your must-read list as well. Business magazines such as Bloomberg Businessweek, Fortune, and Forbes are also valuable for gaining exposure to investment ideas. The major investment advisory services are good, too. You should, for example, try to have access to Standard & Poor's Outlook and the Value Line Investment Survey. The first is a weekly publication that contains recommendations of stocks to buy. The second presents historical records, current reviews, and risk, beta, ratings of all the major securities. Finally, a wealth of information, including security analysts' recommendations, is available on the Internet. In the first edition of A Random Walk Down Wall Street, over 40 years ago, I proposed 4 rules for successful stock selection. I find them just as serviceable today. In abridged form, the rules, some of which have been mentioned in earlier chapters, are as follows. Rule 1. Confine stock purchases to companies that appear able to sustain above-average earnings growth for at least 5 years. Difficult as the job may be, picking stocks whose earnings grow is the name of the game. Consistent growth not only increases the earnings and dividends of the company but may also increase the multiple that the market is willing to pay for those earnings. Thus, the purchaser of a stock whose earnings begin to grow rapidly has a potential double benefit: both the earnings and the multiple may increase. Rule 2. Never pay more for a stock than can reasonably be justified by a firm foundation of value. Although I am convinced that you can never judge the exact intrinsic value of a stock, I do feel that you can roughly gauge when a stock seems to be reasonably priced. The market price-earnings multiple is a good place to start. Buy stocks selling at multiples in line with, or not very much above, this ratio. Look for growth situations that the market has not already recognized by bidding the stock's multiple to a large premium. If the growth actually takes place, you will often get a double bonus: both the earnings and the price-earnings multiple can rise. Beware of stocks with very high multiples and many years of growth already discounted in their prices. If earnings decline rather than grow, you can get double trouble: the multiple will drop along with the earnings. Following this rule would have avoided the heavy losses suffered by investors in the premier high-tech growth stocks that sold at astronomical price-earnings multiples in early 2000. Note that, although similar, this is not simply another endorsement of the buy low P stocks strategy. Under my rule, it is perfectly all right to buy a stock with a PE multiple slightly above the market average as long as the company's growth prospects are substantially above average. You might call this an adjusted low P strategy. Some people call this a GARP, growth at a reasonable price strategy. Buy stocks whose P/ES are low relative to their growth prospects. If you can be even reasonably accurate in picking companies that do indeed enjoy above-average growth, you will be rewarded with above-average returns. Rule 3. It helps to buy stocks with the kinds of stories of anticipated growth on which investors can build castles in the air. I stressed in Chapter 2 the importance of psychological elements in stock price determination. Individual and institutional investors are not computers that calculate warranted price-earnings multiples and then print out buy and sell decisions. They are emotional human beings driven by greed, gambling instinct, hope, and fear in their stock market decisions. This is why successful investing demands both intellectual and psychological acuteness. Of course, the market is not totally subjective either. if a positive growth rate appears to be established, the stock is almost certain to develop some type of following. But stocks are like people, some have more attractive personalities than others, and the improvement in a stock's multiple may be smaller if its story never catches on. The key to success is being where other investors will be, several months before they get there. So ask yourself whether the story about your stock is one that is likely to catch the fancy of the crowd. Can the story generate contagious dreams? Is it a story on which investors can build castles in the air, but castles in the air that really rest on a firm foundation? Rule 4. Trade as little as possible. I agree with the Wall Street maxim. Ride the winners and sell the losers. But not because I believe in technical analysis. Frequent switching accomplishes nothing but subsidizing your broker and increasing your tax burden when you do realize gains. I do not say, never sell a stock on which you have a gain. The circumstances that led you to buy the stock may change, and especially when it gets to be tulip time in the market, many of your successful growth stocks may become overweight in your portfolio, as they did during the internet bubble of 1999 to 2000. But it is very difficult to recognize the proper time to sell, and heavy tax costs may be involved. My own philosophy leads me to minimize trading as much as possible. I am merciless with the losers, however. With few exceptions, I sell before the end of each calendar year any stocks on which I have a loss. The reason for this timing is that losses are deductible, up to certain amounts, for tax purposes, or can offset gains you may already have taken. Thus, taking losses can lower your tax bill. I might hold a losing position if the growth I expect begins to materialize and I am convinced that my stock will eventually work out. But I do not recommend too much patience in losing situations, especially when prompt action can produce immediate tax benefits. The efficient market theory warns that following even sensible rules such as these is unlikely to lead to superior performance. Non-professional investors labor under many handicaps. Earnings reports cannot always be trusted. And once a story is out in the regular press, it's likely that the market has already taken account of the information. Picking individual stocks is like breeding thoroughbred porcupines. You study and make up your mind, and then proceed very carefully. In the final analysis, much as I hope that investors have achieved successful records following my good advice, I am well aware that the winners in the stock-picking game may have benefited mainly from lady luck. For all its hazards, picking individual stocks is a fascinating game. My rules do, I believe, tilt the odds in your favor while protecting you from the excessive risk involved in high multiple stocks. But if you choose this course, remember that a large number of other investors, including the pros, are trying to play the same game. And the odds of anyone's consistently beating the market are pretty slim. Nevertheless, for many of us, trying to outguess the market is a game that is much too much fun to give up. Even if you were convinced you would not do any better than average, I'm sure that most of you with speculative temperaments would still want to keep on playing the game of selecting individual stocks with at least some portion of the money you invest. My rules permit you to do so in a way that significantly limits your exposure to risk. If you do want to pick stocks yourself, I strongly suggest a mixed strategy. Index the core of your portfolio, and try the stock-picking game for the money you can afford to put at somewhat greater risk. If the main part of your retirement funds is broadly indexed and your stocks are diversified with bonds and real estate, you can safely take a flyer on some individual stocks, knowing that your basic nest egg is reasonably secure. Even if you use index funds for all your investments, you might choose to alter the weights of various portfolio components in an attempt to enhance returns. One adjustment that I make in my own index portfolio is to overweight China relative to its weight in the world index benchmark. I do so because I believe that China gets too low a weight relative to its economic importance. Certain peculiarities about China's stock markets lead to China's being underweight both in emerging markets index funds and in total world indexes. Most indexes are float-weighted. If some of a company's shares do not trade freely, they are not counted in the company's weight in the index. Float weighting means that China gets underweight for two reasons. First, none of the shares traded in the local Chinese stock markets in Shanghai and Shenzhen get counted, because these shares have been available only to Chinese citizens, with minor exceptions. Only the freely tradable shares of Chinese companies listed in Hong Kong or New York are counted in the index. A second reason China gets underweight is that the Chinese government owns a huge portion of the shares of many companies, and those shares are not counted in the float. As a result, China gets only about 2% of the weight in the world indexes, whereas, adjusted for purchasing power parity, China's GDP is about 13% of the world's GDP and is growing rapidly. Hence, I believe that investors need to put more China into their portfolios than is available in general world or emerging market index funds. I am, however, true to my indexing beliefs and think the best way to do it is to buy a broad-based index fund of Chinese companies. 3 of them that trade on the New York Stock Exchange are YAO, an index fund representing all Chinese companies available to international investors, HAO, a small capitalization index fund that contains more entrepreneurial companies and ones with less government ownership, and TAO, a Chinese real estate fund. The substitute player step: hiring a professional Wall Street walker. There's an easier way to gamble in your investment walk. Instead of trying to pick the individual winners' stocks, pick the best coaches, investment managers. These coaches come in the form of active mutual fund managers, and there are thousands of them for you to pick from. In previous editions of this book, I provided the names of several investment managers who had enjoyed long-term records of successful portfolio management, as well as brief biographies explaining their investment styles. These managers were among the very few who had shown an ability to beat the market over long periods of time. I have abandoned that practice in the current edition for 2 reasons. First, with the exception of Warren Buffett, those managers have now retired from active portfolio management, and Buffett himself was well above retirement age in 2014. Second, I have become increasingly convinced that the past records of mutual fund managers are essentially worthless in predicting future success. The few examples of consistently superior performance occur no more frequently than can be expected by chance. Assuming that you prefer to invest in an actively managed equity mutual fund, is it really possible to select a fund that will be a top performer? One plausible method, favored by many financial planners and editors, is to choose funds with the best recent performance records. The financial pages of newspapers and magazines are filled with fund advertisements claiming that a particular fund is number 1 in performance. There are at least 2 problems with this approach. First, many fund advertisements are quite misleading. The number 1 ranking is typically for a self-selected specific time period and compared with a particular, usually small, group of common stock funds. For example, one fund advertised itself as, now ranked number 1 for performance. The fund that's performed through booms, busts, and 11 presidential elections. It is implied that this fund was a top performer over a period of 44 years. The truth of the matter, revealed in a small footnote referenced by the asterisk, was that the fund was number 1 only during one specific 3-month period and only compared with a specific category of funds with asset values between $250 million and $500 million. The more important reason to be skeptical of past performance records is that, as I have mentioned earlier, there is no consistent long-run relationship between performance in one period and investment results in the next. I have studied the persistence of mutual fund performance over more than 40 years and conclude that it is simply impossible for investors to guarantee themselves above-average returns by purchasing those funds with the best recent records. Although there have been a few examples, such as Buffett's Berkshire Hathaway, of fairly consistent long-run superb performance, the general result is that there is no dependable long-term persistence. You can't assure yourself of superior performance by buying mutual funds that may have beaten the market in some past period. Once again, the past does not predict the future. I have tested a strategy whereby at the start of each year investors would rank all general equity funds on the basis of the fund's records over the past 12 months. In alternative strategies, I have assumed that the investor buys the top 10 funds, the top 20 funds, and so on. There is no way to beat the market consistently by purchasing the mutual funds that have performed best in the past. I also tested a strategy of purchasing the best funds as ranked by the leading financial magazines. The clear implication of these tests in the laboratory of fund performance, as well as the academic work reported in Part 2 of this book, is that you cannot depend on an excellent record continuing persistently in the future. Indeed, it's often the case that the hot performers of one period are the dogs of the next. The Morningstar Mutual Fund Information Service. If recent performance is not a reliable indicator in choosing a mutual fund, what is? I have often said that the two best things that have happened to the mutual fund industry are the arrival of Jack Bogle, who started the low-cost, consumer-friendly Vanguard group of mutual funds during the mid-1970s, and Don Phillips, who in the early 1990s initiated the extremely useful Morningstar service, which publishes information on mutual funds. Basically, Morningstar is one of the most comprehensive sources of mutual fund information an investor can find. For each mutual fund, it publishes a report crammed full of relevant data. Its reports show past returns, risk ratings, portfolio composition, and the fund's investment style. For example, the fund invests in established large companies or smaller growth companies, favors value stocks with low P/E ratios, buys foreign or domestic stocks or both, and so on. The reports indicate whether the fund has any sales charges, load fees, and show the annual expense ratios for the fund and the percentage of the fund's asset value represented by unrealized appreciation. If you buy actively managed funds, you should look for no load, low turnover, low expense funds with little unrealized appreciation to minimize future tax liability. For bond funds, Morningstar gives data on returns, effective maturity, quality of bonds held, and information on loads and expenses. The Morningstar service also uses a 5-star rating system. It rates past performance, taking into account broad market returns and the costs and risks associated with getting those returns. The top funds are given 5 stars to more than Michelin assigns to the top restaurants in the world. The stars are useful in categorizing past performance. Unlike the Michelin stars, which virtually guarantee the diner a meal of the designated quality, however, the Morningstar ratings do not guarantee an investor continued superior performance. In the past, 5-star funds have not done better than 3-star or even 1-star funds. The wise investor will look beyond the stars in making appropriate investment decisions. Is there any way to select an actively managed fund that is likely to be an above-average performer? I have undertaken many studies of mutual fund returns over the years in an attempt to explain why some funds perform better than others. As indicated earlier, past performance is not helpful in predicting future returns. The two variables that do the best job in predicting future performance are expense ratios and turnover. High expenses and high turnover depress returns, especially after-tax returns if the funds are held in taxable accounts. The best performing actively managed funds have moderate expense ratios and low turnover. The lower the expenses charged by the purveyor of the investment service, the more there will be for the investor. As Jack Bogle, the founder of the Vanguard Group, puts it, in the mutual fund business, you get what you don't pay for. I suggest that investors never buy actively managed funds with expense ratios above 50 basis points, 0.5%, and with turnover of more than 50%. Expense ratios and turnover statistics are available on the fund's websites and from investment sources such as Morningstar.